The 2026 edition of CBRE's annual Capital Markets Symposium offered lots of fascinating ideas and takeaways. And with thanks to those of you who attended, our podcast now offers all of you a ticket to some of the conference's greatest hits. On this episode, the first of several episodes we recorded in Arizona, on stage and off, at this signature event.
This is our Super Bowl. This is the greatest single aggregation of commercial real estate executives in the world right now.
Don't take it from MC James Milan, CBRE's president and co-head of capital markets for the U.S. and Canada. We've got you a front row seat.
And I'm going to turn the stage over to none other than Spencer Levy, host of The Weekly Take, and his colleague, Henry Chin.
Coming up, my conversation with CBRE's Global Head of Research for a wide-angle view on the global economy. I'm Spencer Levy, and that's right now on The Weekly Take. So Henry, thanks for coming, and let's rock and roll, because I think the last time we did this together was 2018 in Warsaw.
Warsaw, yeah, I was bloody cold.
Where it was bloody cold. It's much nicer here today than it was in Warsaw, isn't that right? But today we're going to talk about the economy and real estate and a few issues that matter to our clients here today, public policy, capital markets, megatrends, and then, of course, our best ideas.
Yeah, that's great.
Well, let's start macro then with the U.S. and the global economy. Even if interest rates have remained a little high.
I have to say, for interest rate here, only 3 points I want to highlight. Number one, you can see interest rates is trending down from 25 to 26, 27. Second point, you can see, Spencer, we are still far above 2021's level. The third component, in Australia and in Japan, we are seeing the interest rate hike in 2026. So therefore, the global economy, this is somehow similar, but also different.
Well, it changes everything about how our operators out there need to operate, because we're not getting bailed out by 0% cap rates or lower interest rates. We have to operate better because we're going to be in a high interest rate environment.
Yes, as a result, going forward, income return become more and more important.
Because if you looked at CBRE's own forecast 6 months ago, we weren't projecting much more than 2% growth. We've upped it by several basis points, and each basis point is a lot of money. And I would note that I'm not one to send nasty grams to research, but a few months ago I said I think we might have overestimated the tariff impact on this, and maybe this is reflective of that.
Maybe, yeah. Actually, during the course of 2025, you can see the U.S. GDP economy growth is largely driven by tech investment, and the trend is likely to continue. And I really want to highlight, people are overplay the AI. Give you the tip. Last year, we did a CBRE forum in Hong Kong. They are creating Henry AI. It doesn't work. So that's why I still got a job.
Well, AI does work to some degree. Certainly all of our friends that are doing data centers today, the trillions of dollars going into that sector. But you could see just how influential it was to last year's growth. And if AI is a big component, maybe it will help us grow faster than that 2.5%
Productivity gain is going to be a key going forward.
And a drag, of course, is going to be immigration, because GDP is productivity plus immigration, and that's been a negative. So Tip O'Neill was the Speaker of the House in the early 1980s. He said that all politics is local. Well, I think most of the issues that matter to real estate are local. What do you think, Henry?
Yes and no. When you are playing the cycle, real estate is local. Demand, supply is very local driven. However, there's a big however, there are structural changes. The structural changes could be national, could be global, could be underpin the new demand. So therefore, local is important, but also need to be aware of the structural issues where we are facing now.
Well, I think these are the big issues that people are aware of, big picture, and we'll talk about each one in kind. But I want to talk about them using my fanciest of fancy chart. You want to see my fancy chart?
What?
It's called my two hands. On the one hand, we have all of these issues here: tariffs, immigration, restrictions. On the other hand, we have the one word that matters to our business. It's called math, or getting the best risk-adjusted return. And if these things don't impact that thing, these represent opportunity rather than risk. What do you think, Henry?
100% agree. You can see for the tariff as number one, people overplay the tariff issues. But I have to say, as an economist, I cannot forecast a human's behavior. As a result, we are expecting to see the effective tariff is going to be the mid-teens, Spencer.
Well, look, I'm a big believer in port industrial. I'm a big believer in border industrial between the U.S. and Mexico because I think people may have overplayed this issue. And then on immigration, it's a very mixed bag, right? When I talk about immigration, I talk about the Americas, not just the United States of America, because there's a symbiotic relationship between Canada, U.S., and Mexico. Canada has an advantage on skilled labor. Mexico has an advantage in terms of having cheap labor. But ultimately, it's going to impact some of our industries, including construction, where 30% of all laborers are immigrants. It impacts senior housing, impacts hotels. What do you think?
But I have to say, on a global scale, so when we are looking about labor's immigration, there's more and more countries, they do have refined policies on the immigrants. So therefore, they are attracting the right talent to your country to drive the growth. So therefore, this is something I think U.S. could potentially learn from the global economies.
When we are reshoring a lot of the manufacturing, it's highly automated. So we don't need quite as much labor as we might have when we were swinging hammers years ago. Now, interestingly, SFR BTR restrictions, when I'm at the roundtable, is probably the #1 issue we debate, because not only do the feds, but also the local governments, including places like Texas, are pretty negative on institutions buying this, which then represents an opportunity, because I think they're very, very negative on SFR. They are not that negative on BTR. So there is opportunity here, but it's the one issue we fight a lot. But interestingly, I was in Minneapolis last week. You know, Henry, I was everywhere last week. So were you, for that matter.
Fair.
So I'm in Minneapolis last week, and they are banning the construction of new data centers. What do you think about that?
I think the local restrictions is important for you, particularly when you are planning for your exit strategies. Nevertheless, back to the fundamentals, demand and supply for those living sectors, for the data center sectors, it still give us a good play going forward.
Yeah, well, I think it creates opportunity. As you'll see in a minute, the opportunity in data centers isn't just in the U.S., it may be global. But then foreign investment. In a normal year, whatever normal is, foreign investment represents about 15% of U.S. investment. Last year was less than 4%. But because of Liberation Day, I got a lot of nasty grams from my investors saying, well, you don't want to come back. But if there's a silver lining in the news that happened last year, the U.S. dollar devalued by 11%, which makes the, this hand, math, look a little better.
I have to say I travel across the globe, not because I'm in the US now. I'm talking to global investors, capital allocators. I have to say 2026 is a vintage to invest into the US real estate markets. 3 reasons. Number 1, repricing has been quite substantial here in the US. Number 2, interest rates are coming down. Number 3, we do see the recovery in fundamentals. As a result, US become very attractive on a global scale.
And then I would say the big beautiful bill was a big beautiful win for our industry. I will tell you that because of the roundtable work, this clause called 899, which would have restricted all foreign investment coming in, we got rid of that. We kept the 1031 exchange. We kept the carried interest at 3 years, not 5. Opportunity zones were expanded, manufactured housing. Great. Big, beautiful bill. Big, beautiful win for us.
It's good for commercial real estate space, for sure.
But then there are some local issues that we think about too. And what they give us in the federal side that we lose at the local and the state level foreign capital restriction, the one I worry the most about, is Texas. They restrict your ability to lease to a Chinese investor to only 1 year. I'll tell you what, how's a Chinese investor going to be able to build a manufacturing plant in Mexico if they can't have their symbiotic relationship with the U.S.? So some of these are a problem. What do you think about some of these restrictions?
By the way, luckily I'm Taiwanese and not Chinese. And by the way, I also want to highlight that the demand is coming from diversified. It's not only for Chinese. We do see more Koreans, Japanese, even Taiwanese are coming to Texas. So therefore, it's important, but just be mindful.
Sure. And I think some of these other issues get a lot of press. And I speak with great reverence to what happened last year in California when people realized just how important insurance was. And anybody that owns a multifamily asset in Florida knows how important this issue has been for a long time. But I think, again, I look at the silver lining. The silver lining is people are building more resilient real estate. People are going over to Europe or to England to meet with the reinsurance. And so I think that our situation in terms of building better real estate, being smarter about insurance is going to get better as a result of the terrible tragedy that happened last year in California.
I think the government need to play the key role here because I give another example for Singapore. I think all the developments coming to Singapore need to raise the sea level by 100 meters. Why? Because they worry about global warming. So this is something related to the government policy support will help us as well.
And then some of these other issues, I think the one I get a lot of calls on is local rent control. And I say with, some, I don't know if it's pride, but a couple of years ago, I would go into many of the offices in this room and say, San Francisco is the most oversold market in America. Well, it's now our #1 rent growth market in multifamily. You know where I'm getting the calls now about? New York. And I'm like, you know what? New York's going to be just fine because, yeah, there's probably going to be some rent control put on restricted housing. But what you're not going to have is rent control put on market rate.
Yeah.
And that means there'll be less market rate, means it'll be worth more. So I actually think there's silver linings in all of these things. But this last one here, I have a little caution about. The shift to private capital is something where many of the folks in this room are shifting from large institutions to going to either 401k capital or other non-accredited investors. What do you think?
I am less of a concern to actually bring the private capital into real estate spaces. It shows real estate asset class is as mature as asset classes. So therefore, I'm very pro private capital coming to here. Given the US, the complexity, the liquidity, the debt, I think it's a good sign for our industry.
Okay, well, I think it is a good sign. I'm very pro private capital coming in. I'm just saying we should be cautious. But I also think about the two hands. In the two hands of if these macro issues don't impact the math, maybe you shouldn't worry so much, because I know from being in this business for a long time that sometimes we're our own worst enemy. And I've seen the enemy, and he is us. And this quote comes from one of my favorite Commodores. That's Commodore Oliver Hazard Perry, who's my second favorite Commodore after Lionel Richie. You a big Commodores fan there?
Oh, Spencer, I need to choose my own music next year. And it's not for me, sorry.
All right, well, I'm going to buy you an album and sail on, sailor. Capital Markets. To start us off, Henry, I figured we'd have a clip of the Weekly Take featuring Sarah Queen, head of equities at MetLife, who had this to say about the capital markets.
Look, I think there is a lot of interest, and say people are real estate curious. And as the rates come down, you're going to see that capital starting to flow back. And I think there are a lot of people who have been waiting to deploy for the last couple of years, but have been cautious. And that weight of capital makes it harder and harder to keep saying no.
The weight of capital, what do you think?
I think weight of capital is definitely, there's plenty of capital on the sideline to waiting to deploy into the global commercial real estate market. If I am the capital allocators, which my previous job is, actually I will over allocate US, neutral for Europe. I will under allocate for Asia Pacific.
Okay, well, I think allocation is both at the macro level and then it's the micro level. I remember a few years ago, self-storage was a sleepy little mom and pop business. Then it became one of the hot asset classes in institutional. Now IOS, one of the hot little asset classes now because capital flows are coming in. So anyway, capital flows matter. But what does this mean for what sales are going to happen around the world?
This is quite interesting. We are using this as leading indicators. The CBRE has conducted investment intention survey globally for the past 10 years. We are using this as a leading indicator to forecast the transaction volume. The US got a stronger net addition to invest. So clearly here, Spencer, US is going to drive the growth for global transaction volume.
But it's slow and steady. It's not a massive spike. And in fact, if you take a look at the bigger numbers, it's not a massive, it's kind of slow and steady. What do you think about this?
Yeah, 17% growth is decent, but people always thinking about, well, we are still substantially below historical high, but I agree with you, steady is a good thing for us.
Wait, that's what real estate was when I got into this business 30 plus years ago. Slow and steady wins the race. I think slow and steady is going to win the race again. But I think the race is going to change. So from 2010 to 2020, cap rates came down by over 100 basis points and everybody made a lot of money. Now what's going to happen? Cap rates are going to come down ever so slightly. So you know what you're going to have to do? You're going to have to operate better. You're going to have to grow demand to make the same kind of money you made in the last decade.
I think the fundamental difference is it was a free money before COVID, but now you can see 10-year treasury is going to be linger around 4%. As a result, your return will be driven by income growth.
I completely agree. And I think also, if you take a look at the different asset types that are going to do well, we have our friends multifamily and industrial. They're going to do fine, but there's a little bit of an overbuilding in both of those sectors today. So I think you got to be a little bit more discerning. But look at retail. What do you think about the returns in different asset types?
I always believe real estate is very, very cyclical. Today you're a hero, tomorrow will be zero. Yesterday you were zero, but you're a hero. I think retail and the office is definitely going to be outperformed through the course of the next 5 years.
And office, this year is going to be a good year to buy. You know what was a better year to buy? Last year. And when we take a look at the things to buy, we might not just look at regular real estate. You might want to take a look at public equities. And look how cheap public equities are. How do you read this?
Yeah, if you look at this, I deeply believe there's a dislocation from the REIT market to the private markets. As a result, if you are operating the opportunistic capital, public to private is a viable strategy to get your returns.
And I think you're going to still see some of these REITs shed their non-core assets. They're going to change the way they operate, but this is definitely going to be impacting transactions this year. And in terms of impacting transactions, looking at secondaries, I was at an event the other day with University of North Carolina, and sitting next to me was the head of their endowment. And what he was telling me was that all these smaller colleges were coming to him and saying, we got to liquidate these limited partnership interests because we need liquidity. And look at what these things are selling for. Some of them are selling at almost a 30% discount. What do you think about secondary?
I think it's interesting. I do like the secondary strategies. Transaction volume is still relatively small. The substantial amount of capital has been raised, the dry powder here. This cycle, Spencer, will be somehow very, very different. 13% discount looks attractive in paper, but some of the assets you're going to invest might not be able to recover in values because that's very, very different from the cycle I was in during the greater financial crisis. When I was working for the Chinese sovereign wealth fund, we do a lot of secondaries, core fund US, double-digit return, 20% annualized. So that cycle is similar, but somehow different.
Megatrends.
Let's start with operational real estate.
Let's start with operational real estate. And when we start with operational real estate, which is probably the key theme or a key theme of what we're talking about today, why don't we start with our good buddy, Jamie Hodari, the CEO of Building Operations and Experience, which covers some of our largest occupiers. This is what he had to say.
Everything is operational real estate now.
See that? Even Jamie has short quotes once in a while. Everything is operational real estate today. But there are some people in our industry who don't agree with that. So we had on the show the European CEO of Panettone, and he had this to say.
We are quite traditional, and we try to stay away from the operational side.
So you have these two sides of the coin. Where do you sit, Harry?
It's very interesting because as the investor, you need to know your clients. You need to create the assets which actually occupier want to occupy. So therefore, it's all about operational, enhance your return. If you look at Robert's take, his coverage is in Middle East. Middle East, we are going to see some cap rate compression. So therefore, operation might not be the major issue for them for now.
So the answer, what you're saying is the definition of you should be more operational maybe here in America and less operational, or maybe don't focus quite as much in the Middle East.
Because you get a cap rate compression.
Because cap rates will come down. And when you take a look at the actual numbers, you'll see that you got to make money during income if your cap rates aren't going down.
The good sign is pretty much across all the four asset classes, we are seeing the high single-digit growth, total return for the next 5 years. Particularly, you can see office retail, they outperforming, Spence.
Infrastructure. Infrastructure is now, everybody's got an infrastructure fund. Many of our clients out there have infrastructure funds, and sometimes the line between what is traditional real estate and infrastructure is blurring, particularly in that industrial and data center area.
Infrastructure is so important. It brings the jobs, it brings the demographic, it also brings the services, therefore create a demand for real estate.
Well, what I like to do is I like to learn, just like we're talking about, there may be differences how you look at operational real estate in the Middle East. I think you got to look at infrastructure overseas. So here's an infrastructure change that's happening right now in Vietnam. How do you see this?
Yeah, I've been to Vietnam for the past 10 years for work. You have to say every single year, the country doesn't surprise me in terms of their infrastructure. The high-speed railways, the metro system is just fantastic. That's why that's a benefit for China plus one.
Yeah, China plus one could be Vietnam. And I think when you see Mexico put in infrastructure like this, it could be 1.5 or 1A.
Yeah.
But you're seeing this here globally too. And what did I see when I was in Portugal 3 weeks ago? Lots and lots of investors and no data centers. And they're all going to be putting in data centers in Portugal. They're going to be putting them in Spain because that's where the infrastructure comes in.
Spence, if you're thinking about real estate economy is all about cyclical, thinking about greater financial crisis, both economy, nobody want to touch it. But now you can think if you want to have a steady returns, you want to invest in real estate, Spain and Portugal might be the preferred destination for Europe.
And I think Spain and Portugal aren't just good because they may have some great infrastructure come to them, which they do. They're also underbuilt. And let's just face it, from the global financial crisis till about 10 years ago, maybe even less, Portugal and Spain were not a great place to be.
No.
The banks were bad, unemployment was high, but that underbuilding and the fact that they solved their problems means it might be a great place to be today. But look where they're building infrastructure, right here in the United States. Henry, we are building some trains here in America.
I have to say, coming from Asia, going to Japan, Korea, this is underwhelmed. Come on, US government, you guys need to do more infrastructure. This is a little bit underwhelmed.
Well, I got bad news for you, Henry. You're from Texas. They don't like trains in Texas. Everybody's got a car.
We drive.
Everybody drives. I'm going to give a shout out to a couple of cities here. One city is Chicago, which is a city we're seeing more and more on these lists. But Kansas City. Kansas City, and I say this with love, I may be an expert in nothing except for airports. And I will tell you that until 2 years ago, Kansas City had the worst airport in America. You literally had to leave security to get coffee. Now they put $2 billion into their airport, and it's spectacular. And now they have a train line. And now more and more investors are saying, gee, maybe we should look at Kansas City, because Kansas City has always punched below its weight. I think now might be a time to take a look again.
So follow the infrastructure is a good investment strategy.
All right. Manufacturing. Manufacturing, I think, is a place we should all be looking. What do you think, Henry?
I think demand is coming back. Given the current government's policy, I think we do see substantial reshoring activities. As a result, manufacturing might potentially be a good investment strategy.
Well, I think it's a good investment strategy, as we had on the weekly take, Teddy Kaplan. And this is what Teddy had to say about why New Mountain Capital is backing up the truck on manufacturing.
What we are trying to solve for is typically that it is very hard for a company to move, meaning there's multiples often of tenant investment in the building from what we paid for the building, bolted to the floor, hanging from the ceiling, churning out widgets 24/7, 365, i.e. lots of earnings in the buildings, and that those earnings in the building cover the cost of occupancy by significant multiples. In the retail real estate landscape, 2 times coverage is considered adequate. Our portfolio, on average, our tenants and the overall earnings that come out of our buildings cover our rents by 13 times over.
2 times?
13.
13 times. Big difference. There's real opportunity here in manufacturing, and I think this audience in particular should take a second look at it because you just haven't done it in the past.
Yeah, I agree. But also be mindful, a lot of manufacturers, they might want to build to suit. So therefore, you need to find the right place.
Well, another thing is I often say don't follow the money. In this case, this is one of those times when you might want to follow the money because so much money is going into it. But you should also follow the demand. So tell us about what we're seeing here in demand. And there's manufacturing as our 3rd biggest demand in warehouses.
Yeah, it's only 11%, but I really want to highlight here, you can see 3PL, they are not so-called expansionary net additional demand because the 3PL's demand is coming from general retail and wholesale. The manufacturing is a net expansionary demand. So watching the space very closely, I do think this is a quite interesting investment opportunities.
Well, another place that I think is interesting is industrial demand. You look at all of the older product, no bueno in terms of demand for there. You see the new product, and it's flying off the chart. How do you read this?
Flight to quality happening in office, in retail, in industrial. For industrial spaces, any facility which was built before 2021, occupiers are not interested. I think modern facility closer to the market, closer to the consumer is what they are looking for.
Well, because of this, we're seeing this. Nobody's building, or building fell off significantly in the new industrial space to the point where, almost nobody is building. But I have a very, very different take on this. New is the new. You got me on that one? New is the new, because this is what happens in every cycle. People stop building, and the best time to build is now. The bottom line is a good time to build when others aren't building. What do you think, Henry?
Well, I have a different point of view, Spencer, here. To be honest with you, we do see the oversupply in the logistics spaces, particularly here in the US as well as in Europe as well. If I am a small investor, I will do value-added strategies because some of our facilities, they are in the right transportation hub. They do have access to the power. They just be dated. So spend some money to do the value-added strategies. It might give you the better return than doing the development. That's my point of view.
Well, I'm actually not completely far off from you because I was with a big client the other day in Dallas, and we went around this big room. We said, well, what's your best idea? And you know what they said their best idea was of any asset class, anything? Powered land. It was just powered land. It's like, just get an older data center, or rather an older industrial building, and you can sell to somebody who wants to buy the dream build data centers. You could build a better industrial building, but the scarcity of power for some of these older buildings may be more valuable than the buildings themselves.
Yeah, I have to say, because we look at these trends globally, I always love to use Tokyo as an example. Tokyo is leading ahead of infrastructure. You know what? Like, there's tons of supply coming to the market, but guess what? The value-added play in Tokyo Bay outperform. So watching the space.
All right, labor. And I always have to have a labor section here just to remind people I'm a labor major from the Cornell School of Industrial Labor Relations. But I think that labor is absolutely one of the top most important issues that you have. In fact, I have 5 factors of awesome. And every time I say 5 factors, I always think I'm going to forget one of them. So hopefully I don't do it. It's capital, human capital, live, work, play, infrastructure, and foreign money. But capital and human capital, maybe number 1, is enormously important to everything.
Important for the labor, definitely.
And labor is showing up everywhere. So one of the places it's showing up now is in the graying of the U.S. economy. In the graying of the U.S. economy, over 10,000 people a day turn 65. You just got back from Tokyo. Tokyo has the oldest population in the world. How are they playing the aging population?
It's quite interesting. I think Tokyo was a very close economy. Over the past 10 years, they become more open. They welcome the laborers, immigrants coming to Tokyo. So you see more and more foreigners in Tokyo now. And but in the future, you might go see more robots here, particularly in China or in Japan.
Well, Japan is also focusing a bit on robotics to help labor, but senior housing. The challenge in senior housing is, number 1, people aren't selling a lot of their single-family homes because they're locked into low interest rates. And the second reason is when you're managing senior housing, you need a lot of labor.
Yeah, senior housing is one thing we're looking at the trend is senior housing. You need to be closer to the medical building facilities because the senior people does need to have a medical care as well.
And I think that the fact that people have low interest rates on their homes is also impacting to some degree the multifamily market. And when you look at housing, you take a look at some of the markets that people didn't love. And I said San Francisco 3 years ago was undervalued. How you like me now? New York's right there. But you see a lot of the fast-growing Sunbelt places, including Austin, where multifamily growth is going to be a problem for a little while. What do you think?
If you're not in a distress to sell, I won't sell Austin for now because Austin does have a strong population growth. But also the newspaper overplay those numbers. Actually, all the major markets are in a positive rental growth. So don't read those headlines too much.
Well, I'm going to say the same thing about Austin I said about Nashville a few years ago. I remember Nashville a few years ago. We were overbuilt. Nobody's going to move in there. And then we absorbed it a lot faster. I think the same thing about Austin, Texas. So if everybody's like, oh, we got to get out of Austin. Not me. That is a tremendous market, tremendous with job growth, tremendous with population growth. It's a great time to get in if you can get in at fair market value. And talking about growth, Austin is literally the fastest growing city in America. Nashville's not far behind it. This is what you follow. You follow both the aggregate growth, but then when you look at markets like New York, San Francisco, and Chicago, you look for the growth of high net worth individuals or whatever the segment of the market is that you're going for. And it makes those markets look a lot more attractive if you just don't look at the big numbers and sometimes look at the quality. How do you look at quality, Henry?
Yeah, I have to say the population growth is important, but you need to attract the right talents. For example, San Francisco is a tech hub. If you go to New York, it's a financial hub. You need to understand the underlying population growth and the talent to drive your investment strategy.
Office evolution. No space has gone through greater evolution than office. And there's a mathematical evolution. We just had on the show Brandon Shorenstein. He said he's changed the way he's looked at office from an NOI base to free cash flow base. What do you think about some of the changes in office?
Well, Spencer, I have to say, return to work. No one talk about return to work outside the US. You guys are still talking about return to work. Return to work is a past tense. every single occupiers are back to work. However, your office product in the US could potentially a little bit outdated. So therefore, when you're talking about future of offices, we are looking at transportation, car park here in the US. We need to have a more F&Bs, wellness, and also post-working hours. Do you have a retail facilities, gym facilities? All of those components is the future of offices. If you look at the US major markets, I think we got a long way to go. However, I still go big on offices.
Well, there's been another change in office, and I was down in Raleigh, North Carolina the other day. And I was there with Ted Klink, who is the CEO of Highwoods Properties. And Ted walks me into his building and he goes, "Hey, Spence, what do you think about this restaurant?" I'm like, "This is a pretty nice place." He goes, "Yeah, it's open from 6 to midnight and I own it." Used to be the case that if you were in the office business, you could only be in office, you could only be in industrial, you could only be. What we're seeing now is people are in whatever business they need to be in to drive demand. And who was the forerunner of all of that? None other than Stephen Ross, who we were fortunate to have on the Weekly Take, who owns Equinox, who owns SoulCycle. He got into retail early because he knew it supported office. But this is what he had to say about West Palm Beach.
There's a lot more in life than just working. People want to play, enjoy, and have fun. And I think that you have to really, that all goes part of kind of what you need to create great cities, great places. How you put it together in a package that really attracts everybody that's diverse. Every city that you think of, the great cities in this country, you can identify a certain thing that they're known for. Look, New York is probably the most diverse city. There's the entertainment, the food, everything. Why do young people want to be there? Because there's a vitality. You got to create that vitality within cities.
Henry, what do you think about the evolution of office?
I have to say, office is such important for our global real estate economies. I just have to say the evolution, what Stephen was saying, is 100% agree with him. And there's a long way to go here in the US, Spence. I do deeply believe real estate office is highly cyclical. 25-26 is a fantastic vintage to invest into offices.
Terrific. And then you take a look at the markets where office is doing well and it's doing not. You see Washington, D.C., L.A. not doing that great. But you know what? I think Century City is one of the best submarkets in America. I think D.C. may have the most upside of any office market in America. How do you?
I think what we are trying to do is doing the apple-to-apple comparison is a market level. We are expecting to see the gateway market will first recover.
Terrific. All right, we're just about out of time, so let's go to the end here. We're going to go to final thoughts on what are our best ideas. First, my best ideas, then Henry's. My best ideas, I love Southern Europe because Southern Europe was a bad place to be. Infrastructure's there. Manufacturing, not enough of you are in it. Housing, 7 million units short. You have an aging population. It may not just be traditional multifamily, maybe seniors. Trade-sensitive areas. I think we've overestimated the impact of tariffs, and that creates opportunities at the borders. Infrastructure showed you both internationally and nationally how this creates opportunities. And doggone it, if you haven't been to a Buc-ee's, they took a sad song and they made it better. Think about them when you're operating your business. Henry, what are you thinking?
Okay, I have to say, don't be so greedy. I think my best ideas, number one, is to try to realize your return. We ask you to buy, sometimes I ask you to sell. If you do the early investment for industrial multifamily data center, you make a decent return. Time to sell, to redeploy the capital. My number two pick is office and logistics. Flight to quality, prime location is one. Second one, talking about value-added offices. We don't have office supply coming to the market. Spillover demand will come through. Small investors should look into the spaces to get in cheap, do the value add, make a decent return. Retail is not for everyone. You need to know your consumers. Therefore, retail will outperform. Follow the demographic. Older generation, younger generation will create a demand. The final one is opportunistic, public to private.
Well, Henry, we started today's show with, it's been a long time since we rock and rolled, and I'm glad we rock and rolled again, but it went so well, and I'm so happy to see you. I'm walking off with a whole lot of love.
Thank you for having me here, Spence.
We'll have more from the symposium coming up on the show with deeper dives into the capital markets. So make sure to subscribe to the Weekly Take, and you won't miss out. Follow us on the platform where you get your podcasts. And as always, we invite you to check out our website, cbre.com/theweeklytake, for related content and more. Thanks for joining us, and we'll see you again soon. I'm Spencer Levy. Be smart, be safe, be well.